Welcome back to yet another update on my Hargreaves Lansdown Stocks and Shares ISA portfolio. In this series, I basically talk you through my 6 funds that I hold on Hargreaves Lansdown at the moment, talk you through what's happened in the markets, and give some thoughts on things going forward. It hasn't actually been too long since my last one, but there's been quite a lot of divergence in the market, so my funds are behaving very differently. So there's enough to sort of get us going on. And before we get into it, I just wanted to say thank you guys for almost 200 subscribers. Hopefully this video might be the one to push it over the edge, but I really appreciate all the support on the videos, and hopefully it can continue. So yeah, before we go on to the Excel dashboard and going through the charts and stuff like that, just need to remind everyone that this is not financial advice. This video is for education and entertainment purposes only. So yeah, with that said, let's come on to the Excel dashboard. So here we are then on the portfolio dashboard. We'll start at the bottom. Contributions wise, still nothing since the start of June. I get paid on the 7th, so expect another video quite soon after this one. I should be able to contribute quite a bit this month because I haven't got any stupid expenses, as I have, you can see in April and May, I couldn't contribute anything due to various things, but that's in the rearview mirror now, so we should be able to contribute quite healthily next week, which is good. You can see, let's go on to the portfolio over time. The chart on the right looks kinder than it perhaps should be, and you'll see when we come onto TrustNet, because of that £1,100 and £900 contribution. That's helped cushion the weakness in markets. Well, recently it's come back a little bit, but you can see we had that big fall off there. And if it wasn't for the contributions, I'm not sure if we'd be back at break even or if we'd be slightly lower. But anyway, the contributions have certainly helped. We pushed up way higher. And then, yeah, we've got the portfolio over time chart in a different format here. I'm hoping, well, hopefully soon, the gain bar should fall on top of the contributions bar, and then we'll have a nice sort of smooth trend upwards, which is what I envisioned when it started. But when we come onto the other website, TrustNet, you'll see that I started this series at the complete wrong time. So, yeah, that's that. Not really much to talk on in terms of this table here. We've gained about 100 quid since last time, which is nice, and we're up as a whole £1,571 since the start of the portfolio as a whole is up that much since February. So gaining wealth is always nice, and yeah, that's the plan going forward. The portfolio as a whole, I have talked about this in previous videos, so forgive me if you've heard this before, but we get not a lot of new people to each video, so I'll run through it quickly. There's a breakdown of each of these funds elsewhere on my channel, but it's split into sort of two halves: the defensive, steady component and the more aggressive component. So in the steady component, you've got insurance, you've got UK equity market in the form of Fidelity Special Situations, which is an active UK fund. And then you've got global healthcare and pharmaceuticals as another defensive sector. And the reason for those, very briefly, insurance is uncorrelated to the business cycle. Think about car insurance. No matter if you've got an economic boom or an economic downturn, if you want to drive your car, you have to legally pay car insurance. So that's a sort of forced payment in many ways. Health and pharma is trying to take advantage of sort of an aging population theme. People are more generally fatter and more unhealthy as time goes on, and older, of course. And even if you're taking Ozempic to get thinner and more active, or Wegovy or whatever it might be, you're paying healthcare companies to do that. So that's got a long runway for growth. And then you've got Fidelity Special Situations, which is as I say, a UK fund, and the UK is well known for dividends and capital returns and sort of low volatility. So that's why that's there. And then you've got the 3 other funds which are more aggressive in BlackRock Global Equity Unconstrained, which is a highly concentrated global equity fund run by one of their leading hedge fund managers. You've got American smaller companies, which for me is just exposure to the most capitalistic and sort of innovative area of global markets. And then you've got tech leaders, which again is tapping into that innovation theme, but is actively managed. So it's trading around valuations and the froth that you might see in the tech space. So that's a quick run through of the Excel dashboard. Let's go on to TrustNet now to talk about some charts, and then yeah, we'll give some thoughts about markets going forward. Right, so here we are on TrustNet. A really useful website. I've used it in my other videos. It basically allows you to chart your funds or your stocks against whatever you want, so different sectors, different markets, different benchmarks, all that sort of stuff. And I'm starting off with a chart that makes me look pretty stupid, but I have faith that this will turn around in the long term. So what you've got here is my portfolio versus the global sector, because my portfolio is all in equities. So this is against global equities against global equities. And you can see that I've underperformed by a somewhat decent margin so far. So over 6 months, that's like 3.5%, maybe 4%, mental maths. But you can see the first thing to highlight on this chart is where I started the series, which is here. And if we just slightly extend the time frame to say 3 years, first thing to note is the portfolio is now on top, which I expected to see in this series, but it hasn't been the case so far, which I'll come on to in a minute. But you can see over sort of any sort of, let's do 10 years just for the sake of it, or as long as we can, because BlackRock, the fund, only launched in 2020, so that's why the track record stops at 2020. Anyway, you can see that I started the series here, which is the worst time to have ever started the series in the last 6 years. So 5 years, sorry. So that's the first thing. Although I'm down, it's not just me that's down, it's also the global sector. But zooming back in, what I wanted to cover off was where that underperformance has come from. So if we press show constituents, we can break it down by different fund. So B here is the global sector, that's there. And really you can see that all of my funds are sort of clumped around the global sector. You've got Fidelity Special Situations, which is the UK fund out in front. But the underperformance has come from two main sources, F and G. And they are the Health and Pharma Index and American smaller companies. And there are a couple of reasons for that. So starting with healthcare, Novo Nordisk has been smashed because of idiosyncratic reasons. So the CEO's gone, they're losing market share to Eli Lilly, all that sort of stuff, and that's quite a high weighting in that fund. The second reason is United Healthcare had a big earnings miss, which is unusual, and again that's a huge holding in that fund. I think it's the largest holding or second largest holding. And the third reason is Trump and RFK are coming down pretty hard on pharma. They're aiming to get prices down to global levels because US prices are much higher than everywhere else, or at least that's my understanding of the regulation. And if they can get that done, then it will be massively detrimental to pharma. So stocks are sort of pricing in their probabilities of that happening, which is why it's been so poor. I mean, you can see in the initial drawdown, in the tariff shock, it actually held up really nicely, it was doing that defensive job that I wanted it to do. But it's more the specific healthcare news flow since then that's meant that it's actually made new lows since the tariff bottom, as opposed to recovering like everything else. And then you've got American smaller companies, which has been hit by the sort of Trump double whammy. So with tariffs, with his economic policy more recently, with all the volatility, small caps get hit the hardest. And then you've also got the rate story of if rates are going to be higher for longer due to tariff inflation. A lot of smaller companies have floating rate debt as opposed to fixed rate debt, which basically means they'll be lower profit. They'll have lower profitability for longer than the market was expecting. So that's been hit quite hard. And then the final thing is the US dollar, and those two funds are more US biased than pretty much all of the rest. Maybe not tech, but the other four, Health and Pharma and CT American Smaller are pretty much all in US dollars, and the US dollar has been weak. If you saw my last video, and my short actually, you'll see that the US dollar as a currency has been really weak. So as a UK investor, not only have you got the stock going down, but you've got the currency that the stock is in going down. So it's been a pretty awful time to be in those areas. But just for argument's sake, let's compare those over the long term to the global sector as the sort of benchmark in this example. And you can see that Columbia Threadneedle American Smaller has smashed it because smaller companies typically grow faster than larger companies. They're more innovative. They're more sort of CEO driven. Like the sort of management teams tend to have more of a buy-in to the share price, whether it's stock options or whether it's vested shares or they're family owned or whatever. So they do a lot of buybacks, which boost the earnings per share. And then Health and Pharma, if we just take CT off for a second, you can see that for the longest time, pretty much it did the same job as the global sector, but for lower volatility. And it's only since I started this series that's broken down. It's just quite unfortunate timing, really, isn't it, that that's happened? But yeah, I mean, I think again, that long-term piece with the aging population and people being more unfit and all that stuff, I think it lends itself really nicely to health and pharma, and it's for that reason that I'm happy to stay invested. And yeah, I mean, just for the super long term that I've chucked on here now, the 20-year chart, health and pharma has smashed the global sector. So yes, it doesn't look too smart 3 months in, but I truly believe that I am a long-term investor, and that sounds like cope. I understand that, but I genuinely do have a sort of 20-year time horizon with a lot of my stuff. So more than happy to keep holding these. I'll update you as we go. Thank you for watching. Leave a like, share, subscribe, and I'll see you in the next one.